All right, today we are diving deep into a forensic report on the Waves blockchain. And wow, this one's a wild ride. We're talking about incredible highs, a total collapse, and some really serious accusations. Let's just jump right in.
So let's set the scene. Back at its peak in 2022, the total amount of money locked up in the Waves ecosystem was a mind-blowing $3 billion. I mean, this wasn't some small-time project. Waves was a heavyweight in the DeFi space.
But flash forward to today, and that number has fallen off a cliff. We're talking a drop of over 99%, down to less than $10 million. Now look, a fall that steep isn't just a bad day at the office or a bear market. The report we're digging into actually calls it an extinction event. Yeah, you heard that right.
And that brings us to the huge question at the heart of this whole analysis, right? Did Waves just get caught in a nasty market crash like so many others? Or was there something more deliberate going on here? Let's take a look at what the report found.
Okay, so the report doesn't pull any punches. It lays out what it calls a long con hypothesis. And what that means is it's suggesting the whole history of Waves wasn't a series of unfortunate failures. Nope. It's arguing this was a carefully planned multi-year scheme all designed to pull money out of investors' pockets. So how would a scheme like that even work? Well, the report gives it a name: narrative arbitrage. The concept is actually pretty simple. When your project starts to fail or lose hype, you don't bother trying to fix it. Instead, you just jump on the next big crypto trend, whether that's ICOs, DeFi, you name it. You create a new story, a new narrative to attract a whole new batch of investors, and just leave the old mess behind. To really get what happened here, the report says you have to start with the founder, Aleksandr Ivanov, because the analysis claims that if you look at his career, even before Waves, you start to see a very clear, very specific pattern of behavior emerge again and again.
Now you've got to give him credit for one thing. The report points out that Ivanov was often way ahead of the curve. Coinomet, one of the first instant exchanges. CoinoUSD, basically a stablecoin concept before anyone was really talking about them. But here's the catch. The report alleges that in every single case, the project would launch with a ton of hype, and then, just as quickly, it'd be abandoned. Instead of sticking around to build it out for the long haul, Ivanov was already on to the next shiny new thing.
And this is where it gets really interesting. The report argues that this exact pattern, this narrative arbitrage we just talked about, became the operating manual for the Waves protocol itself. It claims the entire project was a chameleon, constantly changing its identity to chase whatever the hottest crypto trend was, and, of course, the money that came pouring in with it.
And you can see this cycle play out, according to the report, 3 distinct times. First, from 2016 to 2017, when ICOs were all the rage, Waves was pitched as a Kickstarter on the blockchain. When that narrative died down, it pivoted. Suddenly, it was all about enterprise and government solutions, and they raised a cool $120 million in a private round, money that the report claims never actually made its way to the public chain. And then came the big one, the DeFi era. High-yield algorithmic stablecoins, which, as you might have guessed, ended in a complete and total collapse. A new era, a new story, a new source of cash, and ultimately, another failure.
This whole alleged pattern hits its peak with what the report calls the smoking gun. We're talking about the 2022 collapse of their lending protocol, Veers Finance. This was the moment, the report claims, where the curtain was pulled back and you could see exactly how the whole system was supposedly designed to work. So when Veers Finance had its bank run and the dust finally settled, the protocol had a massive hole in its balance sheet. How massive? $530 million in bad debt. Now, in what looked like a pretty heroic move at the time, the founder, Aleksandr Ivanov, stepped in and said he would personally take on all that debt. But the report says you have to look closer at the so-called DeFi revival plan that was offered to the big depositors. Here's the deal they were given. You can either take your good money, your real USDC and USDT, and swap it for the platform's own failing stablecoin, USDN, or you can just leave your good money with us, where it'll earn 0 interest and be frozen indefinitely. The report basically calls this a hostage situation. It wasn't a real choice. It was a forced swap of good assets for bad ones. And if that wasn't bad enough, it got worse. The bridges or gateways that let people move their assets like Bitcoin off the Waves chain, they were shut down. The report calls this the gateway trap. See, your Waves-wrapped Bitcoin was supposed to be worth 1 real Bitcoin. But because you couldn't actually get it off the chain to redeem it, the price on the internal market just cratered.
Your asset, which should have been worth, say, 60 grand, was suddenly trading for 2,000. And there was nothing you could do. Your money was completely trapped.
So the aftermath of all this was just brutal. We're looking at a near total failure of the entire ecosystem. And look, these claims in the report, they aren't just some random person's theory. They're now being echoed in actual legal documents from one of the biggest names in crypto.
I mean, just look at the scale of this collapse. It's truly staggering. A 99.7% drop in the total value locked, that's not a market correction, folks. As the report's author puts it, that is the signature of a dead chain, an ecosystem that, for all intents and purposes, has just stopped working.
And like I said, this isn't just one person's opinion anymore. The bankruptcy estate for FTX and Alameda Research, they've actually filed a lawsuit against Ivanov. And what does it allege? That he secretly orchestrated a series of transactions that artificially inflated the value of waves. The lawsuit claims he then used that pumped-up token as collateral to borrow huge amounts of stablecoins, effectively siphoning real money out of the system before letting the price collapse.
And the red flags just kept piling up. The report points out that the main companies behind Waves were just dissolved, right when people were trying to get their money back. The Waves token itself got kicked off every single major exchange, like Binance and KuCoin, and then, for the final nail in the coffin, the ecosystem's main wallet got hacked by state-sponsored hackers from North Korea. You just can't make this stuff up.
But even after all of that, the story isn't over. In a move that fits the alleged pattern perfectly, the ecosystem has, you guessed it, rebranded again. So the big question the report poses is this a real shot at a comeback, or is this just the final pivot in the playbook?
The report has a name for this new strategy, a lifeboat. See, instead of trying to fix the old broken Waves chain, the new project, called PowerDAO, launched on a totally different blockchain, Aptos. The analysis basically sees this as the ultimate exit strategy. It's a way to ditch the $500 million in debt, escape the now toxic Waves brand, and just start over fresh on a new chain, looking for a new wave of funding.
So after laying all of this out, what's the final verdict from this forensic deep dive? Well, it concludes that the whole story of Waves isn't just about bad luck or poor management. Instead, it argues the whole thing fits the profile of a very sophisticated, long-term strategy that it labels attrition fraud. And this alleged playbook, it says, can be boiled down to 4 basic steps. Step 1, attraction. You build something that looks legit to pull in real capital. Step 2, extraction. You get people to swap their hard assets like Bitcoin or USDC for your own inflated internal tokens. Step 3, encapsulation. When things go south, you slam the exit doors shut, freeze withdrawals, close the gateways. And finally, step 4, rebranding. You launch a brand new project with a fresh new story and start the whole cycle over again.
So what we have here is a really compelling and, frankly, a very troubling story, all backed by on-chain data and now actual court documents. And it really leaves us with a huge question about accountability in crypto, doesn't it? If you see a pattern of hype, followed by collapse, followed by a rebrand, and that pattern just keeps repeating itself over and over again, at what point do you stop calling it a series of mistakes and start wondering if you're looking at a system?